Hello student, let's start with our next topic, that is multi-factor models. In this we are focusing on Fama-French 3-factor model. So what we are going to cover under this topic, that is the introduction about asset pricing models, concept, the reasons behind having asset pricing model, factors in the model and significance, its limitations and implication. So in this particular topic we are basically focusing on Fama-French 3-factor model. Now, we have gone through CAPM model, APT model, single index model. All these three models are basically related to asset pricing model. One of them, that is CAPM and single index, we are focusing on single factors, and in APT we are focusing on multiple factors. In this particular topic also, that is Fama-French 3-factor models, we are focusing on multiple factors. Now, why this particular asset pricing models are important? So, asset pricing models are vital frameworks that help investors to navigate the complexities of financial markets by quantifying the expected returns on the investments based on their inherent risk. So, in CAPM model, we are focusing on market prices, how the market prices are affecting the particular stock. In single index also we have concerned about that thing. In APT we have taken into consideration various systematic factors as well as unsystematic factors depending upon our requirement, and we try to understand how these factors are affecting the stock prices. So, in simple words we can say they provide a framework for understanding how risk factors or risk affect the expected return. What are these risks? Either they are market risk or systematic risk. That means we are concerning about inflation, GDP, money supply, interest rate, etc., or we are concerned about the specific industry rate in case of systematic factors, and how these systematic factors or unsystematic factors or market related factor affecting the stock prices. So, with this particular asset pricing model, an investor is able to identify how different factors are affecting the stock prices. So, whichever model he takes, either CAPM, single index or APT, he is concerned towards the factors that is affecting the stock prices. They facilitate informed decision making, optimize portfolio management and provide benchmark for performance and evaluation. So, with this particular models we can easily identify how we are going to optimize a particular portfolio, how we can take proper informed decision based on the factors which are affecting the stock prices. If you remember in the last lecture, we have gone through two numericals. In a particular numerical, the inflation rate is 6%. So, that GDP rate is 6%, that means GDP is affecting the particular stock highly, whether interest rate and inflation are affecting in a moderate manner. So, individual investor can take into consideration various factors that affect the stock prices. So, inflation is one of the factor that is affecting the stock prices, interest rate is also another factor, and numerous factors are available to investors on the basis of which they can take the decisions. So, as the financial markets evolve, these models continue to adapt and enhance their relevance and predictability in guiding investment strategies. So, if we start with the initial stage, that is CAPM model, then there is CCAPM model that we are going to cover in next topic. Then we have single index, then we have APT, then Fama-French 3-factor model, Fama-French 5-factor model, then we have Cahart 4-factor model, then we have Fama-French 7-factor model that is going on recently. So, with the continuous evaluation of financial market and empirical testing done by the researchers, the financial models are also developing. So, asset pricing model is a continuous phenomena which is continuously evolving with the passage of time and with the development of financial markets. So, while CAPM remains a foundational model, because on the basis of CAPM model, all the factor models, or we can say all the asset pricing models has been developed. MPT, CAPM, we need to understand these two are the base model in finance which are used by fund managers as well as the investors for their investment decision. They remain the fundamental, but with the passage of time and development and empirical testing, further models has been developed. Now coming to this particular Pharma French three-factor model, it has been developed by Eguini Pharma and Kenneth French in 1992. It expands on the CAPM model by adding two factors, that is size risk and value risk factors to the market risk factors. It is already available because in CAPM we have considered only market factor, but in this Pharma French three-factor model, Pharma and French incorporated two other factors, that is size risk and value risk. According to them, these two factors are also very important. When we consider or compare it with APT, APT is more specific towards systematic factors or factors that may affect or outer factors that may affect the stock prices. But Pharma French and taken into consideration the firm specific factors that are basically affecting the stock returns of individual portfolio, or we can say the individual fund. This model considers the fact that value and small stock outperform market on a regular basis. So, we need to consider two things, that value stock against growth stocks and small cap versus large cap or small cap versus big cap. So, they according to them, value stock and small caps outperform the market. By including these two additional factors, the model adjusts to outperforming tendency, which thought to make it better tool for evaluating managers' performance. So, managers' performance, we can say we can evaluate the fund managers' performance here. Now, what are the reasons for development? Why we required this Pharma French three-factor model? We already have CAPM, we already have single index model, we already have APT model. Why this particular model is required then? The empirical observations of market anomalies. Still on the basis of these three models, we are able to understand market anomalies still persist in the stock market scenario, and we need to identify what are the other factors that affect the stock prices. So, it is important for researchers to identify these factors continuously, because we already mentioned that financial markets are continuously evolving, and with coming up of new technologies, new companies into existence, new particular financial instruments into existence, it becomes more prominent for the researchers to understand the dynamics of the financial market. So, with the passage of time, it becomes necessity for the researchers or empirical researchers basically to identify what are the other factors that also might affect the stock prices. So, first observation they came into the consideration of the researcher is that small firm effect. That researchers showed that small companies or smaller companies tended to outperform larger companies on a risk adjusted basis. In simple terms, we know that small firms which are quite unknown to the investors are performing better, and investors who are very matured in investing, they try to search for that particular firms. So, on the basis of this particular anomaly, it become more prominent that we need to understand what is the firm size effect. So, with this particular small firm size effect, we understand how small firms are outperforming against the large firms or big firms. So, larger firms, this phenomena known as small firm effect prompted the need for model that could account for size as a factor influencing the factors. So, with the basis of firm size effect, we can easily capture two conditions, that is small firm effect as well as big firm effect, and how these factors are affecting the stock return or the portfolio return. Then comes the value premium. Evidence indicated that value stock, those with high book to market ratio, that means value stock consistently outperform growth stock. So, as Warren Buffett has already mentioned that he is investing in value stocks, Benjamin Graham already mentioned that they like to invest in value stock. Why the concept of value stock is important? That taken into consideration by Pharma French in this model, and they elaborated with the help of the various testing that value firms need to be considered while calculating the returns. The observation suggested that the market was not fully accounting for risk associated with this type of investment, because individual investor don't take into consideration impact of value stocks on the portfolio or growth stock on the portfolio. They simply calculate the normal returns based on the market factors. So, these two factors are important, and with the dependency on various anomalies, researchers identify these two factors. Then there are certain limitations. The second consideration for going for Fama French 3 factor model is a basic inherent limitation of CAPM model. So, CAPM model we already know is based upon the single factor, that is market risk, which simplifies the complexities of financial market, because we are focusing on financial market only. This limitation became apparent as empirical evidence showed that returns are influenced by more than just stock market only. So, we have gone through APT, we have seen that there are other factors too that might affect the stock prices. If we simply look into the stock market return, that is not a base for investment. We need to consider other factors also, and that becomes a major limitation of CAPM. CAPM struggled to explain variation in stock returns adequately, leading to researchers and practitioners to seek models that incorporated additional risk factors. So, we can simply say that CAPM model has been expanded or experimented by various researchers according to the need and requirement of the financial market, and with the help of different factors they have explained in a better manner. Then the third consideration is the theoretical advances in asset pricing. The first development of multiple factor models. As finance theories evolved, there was a growing recognition or need for multiple factor models because of the APT came into existence that could capture the complexities of asset pricing. Here we are considering asset pricing means stock pricing, how we are pricing the individual stock. So, we need to consider multiple factors that may affect the stock prices. The Fama French model emerged as a response to this need, providing a framework that includes multiple sources of information, or we can say multiple sources of risk. Incorporation of behavioral finance insight, the model aligns with insight from behavioral finance, suggesting that investors may exhibit preferences that influence their investment choices. So, here we can look into two factors like small versus big firms, value versus growth firms. So, individual investors have different choices. So, one prefers small firms, one prefer value firms, one prefer growth firms. So, depending upon their choices, we are taking into the factors into consideration at this particular behavior, actually trying to cover the behavioral aspect of investor while they invest, what type of thinking they have, how they select the individual stocks, that also taken into consideration. So, this model is taking into consideration the behavioral factors also. Now, what are the major factors in this particular model? So, we already know the risk premium factors are there. So, first one is market risk. So, this is the return of the market minus the risk free rate. So, here we are considering upon market and risk free rate of return. It represents the compensation investors require for taking on additional risk of investing in a stock market compared to risk free investment. So, if we take a bond, that is government bond or treasury bill, we are suppose getting 4%, and if we are investing in stock, we are getting more than 4%, that risk premium is taken into consideration. So, market risk premium is basically concerned about how much more return a particular investor is getting from investing in a stock market. Then second one is small minus big. Small minus big means small firm versus big firm. So, this factor accounts for tendency of smaller companies, that is small funds or stocks, to outperform large companies, larger companies in the sense large cap firms on a risk adjusted basis. So, SMB measures the excess return of small cap stocks over large cap stocks. So, we need to understand that in this particular formula we are going to cover two things, that is market risk, second one is size effect. In size effect we are considering two factors, that is small cap firms and large cap firms. Then third consideration is value, that is HML, high minus low. This factor captures the value premium, which is the tendency for value stock. Value stocks are those stocks which are having high book to market ratio and outperform the growth stock. Those means having low book to market ratio. So, HML measures the excess return of book to market stocks over low book to market stocks. So, this is the basic formula of calculating the asset return. So, here RI is the asset, RF is the risk free factor, beta is the sensitivity of RM minus RF that we already considered, market risk premium, SI into SMB, that is small market small minus big, and HI is the multiplied by high minus low and the error factors. Now, let us elaborate these particular components of the formula. So, RI, that is expected return of asset I, RF is the risk free rate of return, BI is the sensitivity of assets return to market return, RM is the expected return of the market, SMB small minus big, HML high minus low, we already know, SI sensitivity of assets return to size factor, and HI sensitivity of assets return to value factor. Previously we are focusing on beta, but here we are trying to evaluate that beta only, but we are denoting it with different terms. Then EI is the error term, or we can say the noise of the market. Then what is the significance of 3-factor model? These particular model is basically used by researchers for empirical studies. So, we need to focus on this factor, that these are not normally or generally used by normal investors for calculating the research. Maybe the fund managers are using it or the portfolio managers are using this, but normal investors are not using this particular formula to calculate the risk premium or calculate the expected return of the stock. So, significance of the 3-factor model, first is enhanced understanding of asset pricing. In the previous model, we are focusing on only simple factors like systematic risk factors or market risk factors, but here we are focusing on the behavioral factors also. So, we are expanding the dimension of understanding the behavioral patterns of investor as well as how they choose a particular investment. So, it provides a multiple factor framework incorporating size and value factors with market risks, offering a more comprehensive explanation of asset returns. Then practical application for investors guides portfolio construction by allowing investors to capture size and value premiums. Performance evaluation and benchmarking, it also helps the investors to compare it with other particular investment or other particular stock, and then on the basis of that they can identify which particular fund is performing well. So, with the help of this particular model, investors as well as fund managers or portfolio managers can evaluate the performance of the portfolio, and it becomes easy for them to go through this and understand the scenario and what factors are affecting them. Then academic contribution and research foundation influences asset pricing theory and stimulus further research leading to more sophisticated model like 5-factor model and 7-factor model. Recently, the researchers are working on 9-factor model. So, it is a continuous process of evaluation. We can say with the passage of time or seeing the dynamics of the market, various anomalies occurs in the market, and researchers try to identify these anomalies and incorporate them in the models. So, it is a continuous work of researchers to empirically validate and upgrade the models with passage of time. Then broader implication for market efficiency challenges the notion of efficient market by demonstrating persistent size and value premium. In this particular model, we are talking about two major anomalies that are prevalent in the market, that size and value. So, if we incorporate these, we can say particular anomalies in the particular formula, then we can see how these particular variables are actually showing their dynamics and predicting, helping us to predict the stock market return, or we can say help us to predict the portfolio return on individual stock return. Adaptability to changing market conditions allow us for dynamic investment strategies that can be adjusted based on the market condition, remains relevant over time, adaptable to research finding and insight. So, if the particular model is propounded in 1992, it does not mean that we cannot use it after this many years. We can use this model, but other models are also prevalent in the market, we can take into consideration that model. If we do not have certain base models with us, we cannot go for expanding the models further, or we cannot go for further empirical testing or validation of the model. So, it is necessary for the researchers to understand this basic fact that all models are important to validate or go for further research. So, it is important to have some base model with us. So, this particular model is basically providing a basics of understanding the market price issue, the size price issue, as well as the value premium issue. So, with the help of this particular thing, we can further elaborate or further go for expanding it and take into consideration other factors that may affect the prices of a particular stock. Now, what are the basic limitations of this model? First one is static factors. Although market is quite dynamic, but we have taken into consideration two major factors, that are size and value, and they are quite stable over time. So, however, market dynamics change, leading to variation in the premium. For instance, period of market stress might alter the relationship between these factors and returns, which cannot be taken into consideration during that point of time, because we are focusing on these two factors only. Time invariant relationship, this model does not account for changing economic condition or shift in the investment behavior that could affect the performance of small cap or value cap differently over period of time. So, we are considering that investors prefer value stocks, some category of investor prefer growth stocks, some prefer big firms, some prefer small size firm. So, these factors are very important while taken into consideration. If we are focusing on small firms and value firms, when we are talking about these two factors, that is small size and value premium, we need to consider that these are certain factors which depend upon the market situation, also varies. So, that particular thing is not taken into consideration by researchers. They think that this will remain constant for a period of time or over a period of time. Then lack of comprehensive explanation. While the model provides a better explanation than small CAPM, it still does not fully capture the complexities of stock market, because there are large number of anomalies in the market that are available and that are more prevalent, but these particular two factors are more important for the researcher, and they have taken into consideration only these two, but there are other factors also. Data requirements. Implementing the model require access to detailed data on stock characteristics. So, it is very important. If we do not have data or certain type of databases, in that condition we cannot go for calculation of these prices, like market capitalization, book to market ratio. Then these are very complex data, they are not easily available in different sites. So, either the researchers have to purchase it, or they should have the access to the database. Only if they have that access, then they can go for calculation of these prices. Failure to explain all anomalies. Despite its improvement over CAPM, the model still struggled to explain certain market anomalies and patterns that we already know, because it is only considering size premium and value premium. So, such as low volatility anomaly, low risk factors have historically provided higher risk adjusted returns is not taken into consideration. So, we need to consider other factors also while taking this particular model into calculation, because there are other factors that might affect the stock prices, but this particular model is taking into consideration majorly three factors, that is market risk, value risk, and we can say the size factor. So, there are other factors that might affect the prices, like it is mentioned in this particular statement that low volatility anomaly, and we are not taking into consideration. So, it might affect the stock prices return. So, the calculation portion is limited, or we can say the model proposition is quite limited. Reliance on historical data. The model effectiveness is heavily reliant on the historical data to identify size and value premium. This dependencies raises questions about its predictive power for future performance, especially in evolving markets like India. So, in case of emerging market like India, it becomes very difficult to identify this particular type of situation or take into consideration this particular thing. We cannot go for future prediction, because it is totally based upon historical data. We cannot take into consideration the other factors. Backtesting bias, the model parameters and factors can be influenced by backtesting bias, where the model performs well on historical data but may not hold up in future scenarios. Overlifting to historical data can lead to unrealistic expectation about future returns. So, in both this particular points, we are mentioning that we are taking historical data into consideration, and we, on the basis of historical data, we cannot predict the future. So, if we take this particular model into consideration, we need to understand that this particular model is prevalent in particular economic situation or economic condition. If there are certain major drawbacks in the market or major faults in the market, that period may be excluded, so that this particular model can be easy for us to predict the future. But in real life situation, on the basis of this model, we cannot go for prediction, because there are certain lacunas or limitation of the model in itself. Now, coming to implications of this particular model, first is enhanced explanatory power for stock return. We are able to understand that we are taking into consideration two major anomalies, that is price and value. So, we need to understand it is expanding the horizon of the model, that is base model, that is CAPM model. So, it is expanding the horizon. So, it provides us better explanation. So, first is enhanced explanatory power for stock returns. So, comprehensive understanding of stock return is provided because we are including size and value factors into consideration. Addressing market anomalies, the model effectively addresses several market anomalies that CAPM fails to explain, such as small firms effect, value premium effect. By incorporating this factor, the model allows investors to understand the underlying reasons for performance discrepancies observed in a market, leading to more accurate return expectation. So, what we are doing earlier in CAPM, we are just focusing on single factor. Here we are focusing on two major anomalies that are quite prevalent in the stock market, and that is why it is enhancing the predicting power of the model. Then risk factor insight, investors can assess how much of the asset return is attributable to market risk versus additional risk associated with size and value. So, three factors. This insight aids in better risk management and understanding the portfolio behavior in different market environment. So, talking about the developed market, how this model is predicting. In case of emerging market, how this particular model is working, we can easily compare it and understand the market behavior pattern also, where because these models have been developed in case of developed market, basically the US data has been used to develop the models. So, these models are predicting the data better in their context. In context of India or other emerging market, there are situations that these models do not able to explain these particular factors into consideration in a better manner. So, we need to understand the situation and how they are predicting it, that also need to be considered. So, with the help of these models, or we can say help of these factors, we are able to capture the predictability of the returns in a much better manner. Next one is portfolio construction and investment strategies. Factors based investment strategies have been used. If we identify that size premium is more sensitive, or value premium is more sensitive, or market premium is more sensitive, accordingly we can evaluate our portfolio. Diversification and risk management, that is also a big driving factor of this particular model. We can easily diversify our portfolio based upon this particular calculation. Dynamic asset allocation, the model support dynamic asset allocation strategies where investors periodically rebalance their portfolio. Based upon the calculation, we can easily go for value stock, we can go for growth stock, we can go for large cap, or we can go for small cap, depending upon the market situation, and we can easily maneuver between these particular categories of stock, and we can rebalance the portfolio. Then third one is performance evaluation of fund manager, that is also very important factor. With the help of this, we can evaluate the performance of fund manager. First, benchmarking, we can easily benchmark the portfolios and we can evaluate which particular portfolio is performing well, whether the consideration taken by the fund manager is good or bad. Whatever he is doing is good or bad, we can easily evaluate with the help of this particular model. Risk-adjusted return: fund managers can be assessed on risk-adjusted basis, allowing investors to compare different funds with varying risk profile. By using this model, investors can evaluate whether higher returns are available to them or not. Then accountability and transparency. This model encourages accountability among fund managers, as they are aware their performance is regularly scrutinized by the investors. So with this, we came to end of this particular topic. Thank you.